Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗽𝗶 𝗖𝗽, and I'm joined by my co-host, August Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Now, our mission is to empower investors to earn passive income through real estate investing. Today, we're really excited because we're joined by 𝗖𝗽𝗓 𝗏. Now, a little bit about Kyle. Kyle is a managing partner of Limitless Estates, and he has his little thing in the corner there. So great. It's a real estate investment firm. He's also an author, a podcast host, and the co-founder of the Asset Management Summit, which is focused on teaching people how to become the best in-class operators. Kyle has been investing in income-producing real estate since 2010 and currently manages and operates 107 million assets under management in multifamily assets in the Arizona markets. Now, we believe this interview with Kyle will bring great value to real estate investors looking to start a real estate private equity company, but also for passive investors looking to learn more about how real estate private equity firms are managed and operated. Welcome, Kyle. Thanks so much for being here.
Welcome, Kyle.
Thank you very much. I appreciate it. Excited to be on.
Awesome. Great. Well, let's just start off by, you telling us about your background and your start in real estate, please.
Yeah, absolutely. So my background originally was actually in the golf business, which is where I started a summer job and was in that business for over 20 years. And that's where I learned a lot of my operations and management experience that I then brought over to the multifamily world. And so I was a general manager and a regional manager for basically a property management company, but for golf courses. So our company managed golf courses for cities and municipalities that own them. And that's where I got a lot of my experience. But I started venturing in real estate investing back in 2010 when I still had my full-time W-2 job. And I was just investing on the side. So I started with single family homes, which a lot of people do in this industry. And I quickly learned it's very difficult to scale in that business. You can make money and do well in any industry, but I definitely wanted to scale in real estate. And I got up to about 10 single family homes and kind of hit a wall with the lending side of things and just also managing everything. I still had a third-party property management company, but it was a lot more work than what I originally had thought with the single family homes because they were all located in different areas. And so I stopped investing for a couple of years and really started looking around at what made the most sense. I've never been a stock market person. And then in about 2015, I really wanted to leave my full-time job for something new. I was burnt out and I was just searching on the internet and happened to find a course online on apartment investing. And initially I found that course and I thought, well, this is kind of only for the rich people, right? That can do apartment investing. It's not for me, but the course was really cheap. So I bought it. My wife and I took it. And 3 weeks later, I was absolutely hooked on the idea of buying apartments, and multifamily syndication is what we call it and what we do. And 11 months after that, I left my full-time job to pursue this full-time. And that was back in 2018.
Incredible story, incredible journey, but it seems to be a common, theme that a lot of people, a lot of our expert guests that we chat with, that they started in single family, they own too many single family properties, and then they made the switch to multifamily. It seems to be a common transition. Now, unfortunately for Canadians, now, I mean, especially in the large cities like Vancouver and Toronto, with medium home prices between $1 million and 1.3, and a medium income around 90,000, it is difficult for people to even scale within that single family. So a lot of times people, have a hard time to buy their primary residence, let alone buy a secondary property and to scale. So they might some active investors might have to bypass that step because it's difficult to own. I mean, if you own 10 single families in Vancouver or Toronto, you're already well over that $10 million mark.
You might as well buy a multifamily in the US, right? At that price point.
Exactly.
Maybe we could just touch on, what was it about multifamily that really piqued your interest to start investing in it?
Yeah, it's just the business model of it. Like I mentioned, I was a general manager and regional manager of a golf management company, right? So every day what I did was manage people, manage budgets, manage projects, but essentially I was measured off of the bottom line of the business. And that is what multifamily is. It has several income streams. It has expense items that you can control, and then it has an NOI, and that's how your property is valued. And I love the fact that there is some control over that. With single family homes, there's not much control, right? Typically it's done by the comparison approach, where if it's a 2-bed 3-bath or 3-bed 2-bath sitting next to a 3-bed 2-bath, they're going to be priced about the same. Well, if I have a multifamily property that I operate more efficiently than the one across the street, mine's going to be worth more. And I love that piece of it. And I had managed those types of assets, which were golf courses back in the golf business, for some time. And so as soon as I found out about the model of it, driving income, controlling expenses, and then driving the bottom line, I just fell in love with it.
Isn't that awesome? I love educating people about how the value is determined on a multifamily, and people are like, wow, that's how that works. It's all about the income it produces, which is really exciting stuff because you're in full control.
Exactly. And the forced appreciation is going in and adding washer dryers and spending a couple thousand per unit, but then forced appreciating the asset by millions of dollars on the back end because of the
just in the first couple
$100 to $150 rent increase that takes place.
Really powerful stuff. And really
we love multifamily.
Now, quick question for you, Kyle. Did you start as a passive investor and then move on to being actively involved and obviously running everything yourself?
I actually did not, which is not common typically. And I would suggest if you're just getting started to always invest passively. However, with my background in operations and management, I did just hop right into being a lead sponsor. Now we invest in our own deals. So technically you can say I invested passively also in our own deals, but I've always been on the active side of things. I never have passively invested unless it's in our own deals.
Right on. Right on. Awesome. Great. Now let's discuss, building a real estate private equity firm. Really exciting stuff. And you've done that. So there's, at times a bit of confusion between real estate operating companies that acquire the assets and they, their own capital, and then real estate private equity firms, which rely on investors for equity, right? So please talk to us about how you started building a real estate private equity firm, knowing your time and resources were going to be split between cultivating and nurturing relationships with investors, and then on the other side, acquiring and managing multifamily assets.
Yeah, fantastic question. Absolutely fantastic question. And so looking back at it 3.5 years ago, it started very slowly. Today where I'm at, I see that we made tremendous strides, but when we were going through it, it really felt like it took a lot longer than it did. But it was being consistent and having a plan and executing on that business plan. So when I first got started in real estate, I knew I had to access other people's money in order to buy apartments. Eventually you're going to run out of your own money. Even if you have millions of dollars to start, you're going to run out of your own money. And that's why we went the route of syndication, where we raise funds from, private investors to buy larger multifamily and then provide them a return on their investment. And by doing that, first thing that we did was we had to educate ourselves. We need to make sure that we were fully educated, had the right team in place in order to execute that business plan, especially when you're in charge of other people's money. There's much more responsibility when you have other people's money on the line versus your own, right? You obviously don't want to lose your own money, but if you lose your own money, that's on you. If you're losing investors' money and you're not educated, that's a big red flag and a big misstep. So first we had to educate ourselves. And then really it was just surrounding ourselves with other people that were doing what we wanted to be doing to understand how to do things. So modeling after others. I'm a big Tony Robbins person, and he always talks about modeling others, not recreating the wheel. So we did model after others, but we started with a newsletter that went out every month to our, friends and family is where it started. We started a meetup, which, started with 10 people, and 8 of those 10 people we forced to be there because they were our family and friends. And then it grew to the point where we had 40, 50 people showing up on a monthly basis and started following us. From there, we started a podcast, and then a second podcast, and then a summit. So it's slowly snowballed, but we went the route of an educational platform because our current friends and family and network were not big high net worth investors. So we had to create that list on our own. There's others out there that do have that list immediately, maybe because of their, and maybe they're an executive at a high-end firm or whatever it may be. But we didn't have that list. So we had to start very slowly by having one-on-one meetings, building our reputation over time. And that's kind of the route that we went in order to be able to raise funds. Now, on the operating side, I had that experience, so I really enjoy the operation side. But the one thing I would have done differently is really had a team further in advance, hired sooner rather than later, because what you find is after having 2 or 3 properties, you do hit a bit of a bottleneck because number one, you've got to acquire the properties. You have to continue to build your list in order to raise capital for those properties, and then you need to manage those properties. And so really bringing on a team of people who fit well in those spots will help you scale a little bit quicker. We didn't go that route. It was really myself and my wife, and then we have some partners who helped along the way as well. But as soon as we got to that 3 property level, we needed to start hiring people to help in those areas.
Got it. And the current model is the operations in-house, or are you guys partnering with active operators? What's the current business model that you're utilizing?
Yeah, so we hire out third-party property management, but we do our own operations kind of in-house. So we have a full-time asset manager that is on our team that focuses on the execution of the business plan now. And so he is spending all of his time on that. Now, I still oversee it. I still visit our properties. I actually just moved to Arizona earlier this year, just for the sole purpose of being the boots on the ground, to be able to, see, feel, touch our properties and manage them, but also to build stronger relationships out here with brokers to get truly off-market deals and better deals.
Yeah, and most of your deals are focused within the Arizona market?
Correct. We have one in Texas right now. We have a boots on the ground partner out there. So we will start to expand in that market just to give our investors more diversity. However, we are mainly focused in Arizona. So most of our portfolio is in Phoenix and Tucson. Got
it. And just to touch on one point that you brought up earlier was that the realization of, hey, I need more equity to be able to do more deals. Believe it or not, I mean, this happened to me personally as well, is the limitation that it causes on someone who's actively involved in real estate. I've been in real estate for the past 15 years. And for the first decade of it, the concept of raising private equity or raising capital to do larger deals never came to my mind. I was building single family and I would partner with family and friends, but I never saw it as I'm raising capital. And that switch, that change in the kind of the view of the business is huge, because people put this limitation on them that, hey, I can only afford a $500,000 home. How can I, scale this business? But as soon as you realize that, when having access to private equity allows you to do much larger deals and be the general partner is a super important part of this business, is that realization.
Absolutely. And it's great for people like you to come on the show and talk about it, because people would never believe that they can achieve, buying multifamily and all this stuff. So it's really, really exciting to see kind of how it's done and
Yes.
talk about it, right?
And at times, some people are sitting on a gold mine without them even knowing
Yes.
it. I mean, we know many physicians who've made the switch from being physicians into being, involved in real estate private equity. And then, that you were talking about building that list for them was very easy. It was just getting in touch with many physicians that were their friends and associates and peers and saying, hey, this is what I'm doing now. And it was very easy. I know people that are pilots and who utilize, leverage their
network, because they can speak the same language. They can talk to those people on the same emotional level and understand them and stuff. So yeah, definitely.
And some people can just call their parents. Hey, Dad, I need $10 million. Can you?
Wouldn't that be nice?
Yes, it would be very nice. So
that's okay. We're all doing it the good way. I love that.
Absolutely.
Now, Kyle, what are your predictions for the multifamily sector in 2022 and for the next 5 years?
I wish I had the crystal ball to answer that perfectly, but my thoughts are that, the Fed's announced that they're going to be raising rates probably 3 times next year. I do think interest rates overall will still remain at historic lows. Right now they're in the 3s, which is still extremely low. Even if they creep back into the 4s, it's still historically on, an average, very low interest rates. I mean, I talked to people that they say back in the 70s and 80s, rates were in the high teens, which is just absolutely crazy. So I do think that the rates will rise, which will possibly increase cap rates a little bit. But I just think that real estate's very hyper local, number one, right? So what happens in Arizona is going to be a little bit different than what happens in Texas, Florida, and all those and other markets. And so I can only really speak to Arizona. And the reason why we love Arizona is because they have a long-term plan, and we're long-term holders, right? We believe in real estate investing over the long term. So I'm not as concerned as what's going to happen over the next 12 months. However, we do have to keep an eye on that and keep a pulse on it. But I want to make sure the market that I'm investing in is more of a long-term type of market. And we love the fact that they're pro-business. They're bringing in people every day. Net migration. Arizona has 220 people moving here every day. Phoenix in general is building out infrastructure, building more freeways, which means more jobs are coming in, higher wages are coming in, which is fantastic. So I like this market for the long term. As far as 2022, I think it's still going to be a very strong year. Supply and demand is a very simple way to look at it. And in our market, there's just not enough housing, and so there's too much demand and not enough supply. So I think in the space that we play in, which is B and C class assets, it's going to remain very strong. Cap rates are going to remain around the same or even compress a little bit over the long term. In 5 years, I have a little bit of uncertainty because of what's happening on the tokenization and Bitcoin, the cryptocurrency end. We're starting to hear a little bit about tokenization of real estate, which will make real estate a liquid investment. And I'm not an expert on this, but it's something that's in the back of my mind right now. What will happen to our market if that does happen? Because it will be even more difficult for people to buy real estate if real estate becomes a liquid investment. And let's just say we can sell our securities to people in Canada, in Japan, in Europe for just $50 a token, let's say. So that is kind of something that's undetermined. I think there's a runway of 3 to 5 years left in our industry for sure, but there's a lot of advances in technology that are going to change over the next 3 to 5 years, where I try not to predict that far out because of that. And really, we're just focused on, our market and what we feel is prudent for our investors, just buying in good areas with cash flowing assets, with the solid business plan.
Great. And just to touch on that a bit more, your prediction is that if real estate does go the route of tokenization, that will actually be a positive influence on the market itself or on the sector?
Well, it will get to a point where real estate can only be purchased by the top 1%, essentially, because real estate values will shoot up tremendously because of the liquidity of real estate investing, right? So if I'm selling you a token for $50 for a property, you can then go sell it to anyone on the open market for $100 if you wanted to, right? And so it's an interesting concept. I don't know if it'll take 10 years or 15 years, but I do know, and we're looking into tokenizing our real estate as well. So I do think that the value of real estate will go up because of it. What it will do in the future, though, is it will limit the access to purchasing real estate as a physical property, because it will only be available essentially through tokenization. Does that make sense?
It does make sense, but just we're very familiar with tokenization, as all of CPI's investments are tokenized and available on a secondary market for trade through our partnership with Token Funder. And it's been in place for well over a year now. So we're very familiar with this space. Now, my view and my prediction of that is, yes, that might end up, if it goes mass and it goes mainstream, and most real estate private equity firms utilize the tokenization technology. But what it will do is, yes, it might drive up the price of real estate, but also groups like us, it's much easier to sell our securities through the tokenization process. So it allows us to raise more capital from a larger pool of investors. So yes, it's going to be more difficult for just not a private equity firm to buy a multifamily asset, but the process of raising capital, that's the view, and kind of the view that we've had about tokenization is making it a lot easier to get involved and purchase securities. Now, currently, as far as what tokenization has done for us, it doesn't change our minimum. So on most of our investments, the minimum is 25,000 or 50,000. The investors receive limited partnership shares. Now those shares are tokenized and now available on a secondary market for trade. The secondary market currently is not very large, so it's like, imagine a stock market, but there's not a lot of people buying and selling. But the initial investor still has to invest that minimum investment. So it doesn't allow someone to come in and buy at $50. It just allows the initial investors to come in and buy at the minimum, and then they can sell parts of their investment on the secondary market. So very interesting conversation, but we're
the future of real estate.
Definitely.
Yeah, and I agree with you that it will give more people access to invest in real estate, but not buy the actual underlying asset itself. There's going to be less people that are going to be able to buy the underlying asset because the values will essentially be so high. But to buy a token or to invest in real estate, there will be more access to more people. That's my opinion of it.
Exactly. Exactly. Great.
Go ahead.
Oh yeah, this is mine, right? So okay, let's switch the conversation a bit. We consistently see people leaving their jobs, their careers, or the W-2s, as it's called in the US, to start becoming real estate investors. Our good friend Dan Hanford with passive investing has done an incredible job. I mean, what he's done from leaving his job as a doctor, as a chiropractor, to managing one of the larger private equity firms and having well over $1 billion of assets under management, someone we look up to. And it just shows the excitement that exists in this space for people leaving their jobs. But since you were also have gone through the same journey, is this transition for everyone? I mean, we hear it so commonly that it feels like, hey, anyone can do it. But is this made, like, after being through it? I mean, we can also give our view of it. But having been through it, do you believe that switching your career, everyday job, and getting involved in real estate, private equity, is it for everyone? Is it possible for anyone to do it?
It is possible for anyone to do it. I don't know if it is for everyone. I think there's definitely some misconception that it can be done overnight. It's, at least in my business, our business, syndication, it's not like you make a lot of your money up front in the buy. You actually make most of your money on the sell. And so, we've been a beneficiary of a good market. So we've been able to get out of our deals or turn full cycle on our deals a lot quicker than the 5-year typical hold. We're doing it in 1.5 years, 2 years right now. But it can definitely be done, especially if you have a partnership in what we had with my wife. We looked at it like she was the cash flow. So she kept her job and kept, was able to make enough money to pay the day-to-day bills. And then I was the equity, right? I was out building the equity piece by buying properties. But I do think that anybody can do it if you're driven and determined enough and you surround yourself with the right people, which is the number one thing I would tell you to do, is surround yourself with other people who are already doing it, and you'll scale there a lot quicker. One thing I also like to point out is that a lot of people think they have to replace their W-2 income, right? So let's just say you make $200,000 a year. Everyone says, oh, I have to replace that first in order to be able to leave my full-time job. But with real estate investing, there's so many benefits from a tax perspective, from in investing with using other people's money perspective, that you don't really need to replace that $200,000, because in the W-2 world, you think about what you make, but in investing, it's what you keep, right? So it doesn't matter what you're making. If you're making $200,000, but you're paying 40% tax, you're only keeping 120,000 of that. Right. Well, in real estate investing, the way I'm set up, I'm not paying very much tax, if any at all. So I don't need to replace 200,000. Now all of a sudden I only need to replace 120,000. And the person with a W-2 job needs to save $50,000 a year, let's just say, to invest into a syndication or into the stock market so they can actually have investments. Well, every time we buy a property, we get day one equity, right? And we are also investing, or I invest my acquisition fee, which is based off of other people's money. So I don't have to save that 50,000 to invest, because every time we get a deal, we're investing. So that 120 now becomes 70,000, right? And so do you have to replace your $200,000 income? No, you probably only need to make $70,000 and you'll be in the same exact spot, probably better, because you'll be set up more favorably from a tax perspective. So that's the way I look at it. And, every time we buy a deal, I'm getting a lot more than $50,000 in equity in the deal as well. So you're actually investing a lot more. So a lot of people don't know that when they get started, but that's one of the major benefits of investing in real estate.
And you're hoping for that trajectory line to go up, but initially what you're saying is that, hey, if you're making $200K a year and you want to kind of transition to becoming an active investor, if your first couple of years or first few years you're not making that 200K, you're still going to be in a good position because you're not paying as much tax. But the plan is to eventually surpass that 200K and make millions of dollars a year.
Yep, exactly. Or, you know, the way I did it is I actually saved up a nest egg, and I thought it would have to be X number of dollars. Well, if you want to just do $200,000 a year times 3 for the first 3 years, you're thinking you need $600,000 in, you know, savings, but really you don't need that much money in savings because of what I just explained. Maybe you only need $200,000 that'll last you 3 years. It's just an example. Obviously, you can poke holes in that all day long, but it's a mindset shift on how it works in real estate investing.
Great way to explain it. That's awesome. Let's chat about your book, Best in Class. I believe the book focuses on asset management. Maybe you could please tell us more about, you know, your book, where the idea came from, and some other golden nuggets that people can take away from your book, please.
Yeah, absolutely. So it's Best in Class, and the way it came up is just there's a gap in this industry right now where there's a lot of education out there on how to get your first deal, how to raise capital, which is all things you should learn about, right? But that's kind of the sexy part of real estate, right? Hey, I closed on a $10 million deal. Hey, I raised $2 million of capital. And no one was talking about, hey, what do you do with the asset once you have it? A lot of people think, oh, let's just give it to our third-party property management company. They're going to take care of it and everything's great. And in the last 15 years, since, you know, the market's been so hot, you probably could do that and be successful. But there's a management piece of it, even if you have a third-party property management company, that allows you to drive your NOI even further and drive more value. And I know people say you make your money on the buy side in real estate, but I'm a firm believer that in multifamily, because of the forced appreciation, it is so important to have the skill set or someone on your team that understands how to drive the bottom line, how to execute your business plan, and how to hold your third-party property management company accountable so that you get even better returns. I mean, you're talking about millions and millions of dollars of difference between, you know, just $100,000 in NOI. So if you know how to manage your properties efficiently and properly, you will get millions of dollars more on the back end. And so there's a huge gap where there's not a lot of education on what to do with a property after you close on it. And that's where we came up with the idea for the book. Because my background is in operations and management, I thought it was a perfect fit, and I'm very passionate about it. It's what I like to do in our business is manage the assets. And so we came up with kind of a book that you can flip to any chapter. You know, if you're in due diligence, you can flip there. If you want to know about sales and marketing, leasing strategies, disposition, you can just flip to that chapter, and it talks a little bit about each of those topics.
Oh, that's fantastic!
Amazing.
Really
just
great.
a quick question. Now, you're a scholar on the topic of asset management. You've literally written a book on it. So let me ask you a consistent question that comes up, in the real estate private equity space, where should real estate private equity firms self-manage properties, and should they be vertically integrated with the operational side in-house, or do you lean more towards third-party property management? What is 𝗖𝗽𝗏 𝗖𝗽𝗏 what is his take on that, or what is your prescription? What do you prescribe when it comes to this topic?
Yeah, no right or wrong answer here. So I was in property management, but for golf courses, as I mentioned earlier, right? So I know a lot about that business, and it really is, it's a thankless business. It's very low margins, and it is a lot of work, tedious work, to have your own property management company. A lot of people do that to be fully integrated so that they can have the control piece, right? I don't think that property management companies is a large profit center, and it could be a loss in some cases, depending on how you want to manage your properties. However, you have the full control over it. My rule of thumb is that if we still have a third-party property management company and a partner that allows us to be flexible, which ours do, and that does a good job, then we're going to allow them to do it because they're the pros, and they can focus on that full time.
What do you mean by allowing you to be flexible?
Well, so a lot of property management companies have a built out infrastructure, and they do things a certain way, whether it's reporting, communications, how they hire. We've been lucky enough to be able to sit down with our property management company ahead of time and say, look, this is kind of what our expectations is. This is our growth pattern over the next 5 years. This is where we want to be. this is how we like to see certain reports. And they've come back to us and said, okay, we're going to work with you and customize those certain things. So if you can find the right third-party property management company that's going to allow you to do that, and they do a great job, then for us, there's no reason to go out and start our own property management company, because like I mentioned earlier, the biggest thing is really the control piece of it, being able to control things the way you would like your company to run. And right now, our property management company allows us for that flexibility. So we're okay with having third-party property management. But I do understand why others are vertically integrated and start their own.
Got it. And looking at it from perspective of a passive investor, looking at a bunch of different operators that are in this space, and they're making a decision which operator to invest with, is the component of having a property management in-house. Is that something that they need to have as part of their due diligence when they're looking, or should that be a significant factor in their decision making when they're deciding what investment firm to invest with?
I don't know if it's any different between if they use third party or if they have it in-house. It's really about the behind the scenes. Is that property management company qualified to be running it, whether it's in-house or not, right? What's the infrastructure? Do they have someone else running it, or is the person who's doing acquisitions also running the property management company? So just saying you have in-house doesn't mean much to me. It's, who's running it? Are they qualified? Do they do a good job? And I think a lot of other people start their own property management company because they're in markets where, there is no good property management company. That's one of the hardest pieces to find. And they are responsible for executing your business plan. So it is the most important hire. So, but if I start a property management company and I can't manage my president or my property management company and it's not doing a good job, it doesn't matter if it's in-house or third party. So I would go a level deeper and understand who they use and, what are their standard operating procedures and how they performed. It's just like picking a sponsor, right? What is your track record? What is that third-party property management company's track record?
Yeah, nice.
Great points. All right, coming to the next segment of our show. Exciting.
The 10 championship rounds to financial freedom. So Kyle, whatever comes top of mind, and we'll start with the first question. Who is the most influential person in your life?
I would say Tim Ferriss. I'm a huge Tim Ferriss person. His podcast is a guilty pleasure, but when I look back, he's the reason why I was able to leave my job. I read his book, 4-Hour Work Week, and in there they have a fear setting exercise. And basically he just says, what is the worst that can happen if you left your job? What is the worst that could happen after that? And you keep going down the way. And what I found out is that the worst thing that can happen is I would have to get another job in the golf industry. So I was literally sitting in my worst nightmare as I was doing that exercise. And it helped me just have the confidence in order to leave my job. So that was the stepping stone for me in getting in this industry.
Great perspective. Great
Incredible.
perspective.
My next question is, what is the number one book you'd recommend? And you mentioned that one. Do you have another one?
Yes. So Who Not How by
Dan Sullivan.
Dan Sullivan. Yep. I just joined Strategic Coach as well. But that book is an eye opener, and you have to hire people around you. But when you understand how he puts it in Who Not How, everything I look at now in my business is who, it's not how. So that's really changed my perspective, and one of the best books I've read actually this year.
Oh, fantastic. All right. Next question. If you had the opportunity to travel back in time, what advice would you give your younger self?
Yeah, go straight into multifamily and hire a team sooner than you need it.
Yeah.
Certainly. Yeah. It's surrounding yourself with people who are experienced in the business, but also just a team. Imagine if you could start on day one with a C-suite of executives going out, working full time and hitting the pavement. You would be miles ahead of it versus you doing everything, right? I'm doing the meetup, the monthly newsletters, the acquisitions, underwriting, property management, all that stuff. You're going to be spread too thin. So hire immediately.
Asset manager is the key. Now, a quick question in the middle of this. I shouldn't be doing this, but I'll do it quickly. So now, asset manager, for groups who are looking to invest in multiple markets like we do, we can't have just one asset manager in Arizona because we want to invest in Texas, we want to invest in Florida, North and South Carolina. Would your advice to smaller firms or even larger firms is to have an asset manager in each state, or have an asset manager in-house that travels to multiple states and looks after the property managers? What would be your recipe for that?
Yeah, we really only focus on Arizona. So we're in a position where we're quite lucky because we hired someone who lives in Arizona that could just go to each of our properties. We do want our asset manager to visit the properties. So, if you're a smaller firm and you only have one or two here, one or two there, you can hire someone that's remote that has to travel, but they certainly have to be available to go put their boots on the ground in the market.
Yeah.
Great, thank you.
Hijacking the 10 championship round.
Sorry.
Just kidding. That was awesome. Next question. What is the best investment you've ever made?
Myself, 100%. And so, one of the ways I got started was hiring a mentor. And I think in this business, when you're raising capital from other people, it's essential to get an education. But my mind started changing back in 2009, 2010, when I started investing in myself, reading books, podcasts, paying for masterminds, paying for mentorship. And my life has never been the same since that. And so really it is an investment in myself.
I love that. I love that. Now, what's the worst investment you've ever made, and what lessons did you learn from it?
Yeah, probably my single family homes that I purchased, and one set in particular, I had a really strict criteria. When I first started investing in real estate, I bought in California because that's where I lived. And I quickly realized that I wanted to invest in landlord-friendly states because I placed a professional resident. He didn't pay me for 7 months. I tried to do the eviction process by myself. I realized that even if I took $1 of rent, that the eviction process would have to start over because it's me accepting rent. And so it was a nightmare. And so I said, I'm only investing in landlord-friendly states going forward. And so that's when I started buying my single family homes. And then I let cash flow get in my mind, and I started chasing cash flow. And that led me to some properties in Chicago, which is not a very landlord-friendly state. And I paid the price for that. The first year was fantastic, high cash flow. I was bringing in a lot of money. I thought it was great. And then all of a sudden the eviction process had to start, and it was a nightmare. And so, stick to your criteria is essentially the biggest lesson on that one.
Absolutely. Have cash flow, appreciation, and force appreciation in a real estate investment, then you're all set.
And, and cherry on top is landlord friendly.
Yep.
All right, next question. How much would you need in the bank to retire today? What's your number?
So being in the business that I'm in now, I don't think I'll ever retire because I love what I do. And it just doesn't, it's something that I could do until I'm 90, if I have the right team around me. So I don't know if there is a number, to be honest with you.
It's never ending.
Maybe a cash flow number.
Maybe a cash flow
number. Yeah,
number.
I'd love to cash flow $1 million a year is one of my goals. So
nice. That's a great goal.
A nice one. Yeah.
That's a great one. All right, next question. If you could have dinner with someone dead or alive, who would it be?
I think Tony Robbins. I really respect him, and one of my goals for my wife and I is to go to Date with Destiny this year. And we've gone to UPW, and he's fantastic. But if it was just a dinner between him and I think that would be a pretty cool conversation, and I'd be able to learn so much from him.
Or a round of golf, then you have him for 4 or 5.
Yeah, there you go. Right. That's right. Longer than dinner. I like that.
Now, if you weren't doing what you're doing today, what would you be doing now?
Well, I'd probably be stuck in the golf business still, and really not happy because I was not happy where I was at that point. And so I'm grateful for the opportunity to be in this business, really grateful for my wife for pushing me to do this and being a support system. But yeah, probably just in the golf business still.
And our investors, a lot of time, need to understand that since we've built them one by one, our investor community, we care about this business so much because one bad deal or something unscrupulous that could happen could ruin a reputation forever. So we're very, I think apartment syndicators are very careful about their reputation and the investments they make and their relationship with their investors because it's one by one.
Literally one 100%. By one. Yeah. This is my favorite question. Book smarts or street smarts?
Street smarts. Because I'm not book smart. So street smarts, you learn by doing, and in this industry, the more you do, the more you learn. And so I've learned a lot from books, but there's no replacement from taking action and actually going through it. You can learn how to make an offer and submit an LOI on an apartment building, for example, but you don't learn everything you need to until you actually submit that LOI and you get feedback from the broker or the seller, learning about terms and then the lenders and all that kind of stuff. It just goes miles and miles deeper than just submitting an LOI. So there's no replacement for street smarts.
Yeah, a doctor, surgeon can study for decades, but until they haven't cut somebody open, they don't know how it is. So.
Yeah, absolutely. Okay, last question. If you had $1 million cash and you had to make one investment today, what would it be?
$1 million cash. I don't know that I'd be able to spend $1 million through this route, but I would join the highest level masterminds around. So like the Tony Robbins Platinum Club, I think costs $85,000 to $100,000. But I would want to surround myself with people who are 10 levels above me. And so I would invest that money into those types of masterminds. And I think that because of that, I would be able to scale a lot quicker and be around the people that I want to be around.
That's awesome. I've never heard that one before. That is the best.
Kyle takes investing in himself to the next level.
Well, then that's incredible. I love that answer. Kyle, what's the best way people can reach you?
Yeah, you can just go to our website, and it's limitless-estates.com, and we have a bunch of information there. We have a free passive investors guide that tells you all about multifamily syndication and the things you should know before you get started investing passively.
And buy Kyle's book. Very excited about that. We'll have all this information in the show notes.
Absolutely. And thanks for being here today,
Thank
Kyle.
you so much for
awesome.
being here. Really appreciate it. And yeah, look forward to watching you grow, man.
Yeah, thank you. It was a pleasure being on. Thanks for having me.
Thank you.